All right, what's up, guys? So recently, I had a good friend of mine ask me a bit more about my system, and a lot of you guys have been asking me about my system because of that whole Alpha Illustrated interview. And there's a lot of nuances to go with the system. It seems very simple, and truthfully, in that interview, I even said, "Hey, my approach is overly simplified and pretty straightforward." Um, and then I kind of dig into like, hey, I use market structure, I use 200 moving averages, and I use support and resistance, which I use those in the form of like gray boxes, and then the occasional Fibonacci draw, usually when we're in price discovery. So just to kind of give everybody a bit better of an understanding about how I approach things, today's video is going to be more about technical analysis. It's not really going to be so heavily psychology based because you guys know that I am primarily like that is kind of my bread and butter, right? That's kind of where I shine, and I deem that my forte or whatever. So not as much psychology. However, I do want to kind of front run myself and say the TA aspect of trading is very much arbitrary, right? In my eyes, uh, it's just vanity. It's a way of portraying these very simple concepts of like, hey, if I look at this chart, from April to current price, which way are we trending? Okay, well, we're heading to the bottom right corner, right? And even when we zoom out further, you could say, hey, from November to today, which way are we trending? And then a 4-year-old would be able to tell you, well, we're heading to the bottom right corner, right? So TA to me is more of an arbitrary way to portray that very simple understanding. And it's nothing more than that, right? How you go about approaching that analysis, that very simple concept, kind of determines are you a winner, are you a loser at the end of the year, right? So that's the way that I look at it. It's not so much like, this is my alpha, this is my edge. It's reaffirming ideas that I already have just based off of looking at things and taking it at face value for what it is, right? And it's a way for me to give my puny little brain a way of justifying those thoughts so that I can actually go and take action off of them and hopefully make money, right? So let's dig into it a little bit. I am a price action trader that uses things like market structure along with 200 moving averages and gray boxes, right? I get a lot of questions about Mercury. How do you draw your support and resistance? It's very simple. Do not overthink it. Don't hurt yourself. It's every single time that I see consistent taps at a single kind of horizontal general region, right? And I emphasize general because I'm primarily like a swing trader. I'm not really on the 5 minute. You very rarely catch me on the 15 minute even. So I don't really scalp, right? So I don't need a very precise understanding of where is the support and resistance. You could also kind of cheat, is what I call it. I call it cheating. But this is a less speculative kind of way of viewing things. When you have ranges, though, you tend to have volume kind of mixing all within that price action. And that's not really going to give you too great of an understanding of where is the support and resistance. It's just giving you an idea of, hey, there's a large volume block here. And that's obviously the point of control. But really, you can say, for the majority of that, that's kind of all one block, so you would have to label all of this as support and resistance, right? And that's a really big gray box, and that's not an actionable analysis. So there's times where this fixed range volume profile is a bit better, but I primarily, like 99% of the time, just rely on my own very simple understanding of where is the support, where is the resistance. So very simple. I'm just drawing gray boxes every single time that I see something tapped, right? So we could go straight across. And this is, again, it's very arbitrary. Like you might not see the same gray boxes that I see, right? The 4 hour 200 moving averages, which is what we're currently looking at, I get a lot of questions about, hey, Merc, the 4 hour 200s, 4 hour 200s, 4 hour 200s, right? I get a lot of questions about charts about the 4 hour 200s when charts look like this. And it's like, what the hell is going on here, right? We're trading below and then we're trading above and then back below and then back above and back below and back above, but back below again, back above, right? You're not really giving yourself any sort of edge there. There's no alpha using these 4 hour 200s. You want to stay dynamic. You want to stop kind of force feeding your system onto the market and instead just kind of ask whatever chart you're looking at, hey, what is it that you respect, right? So in this sort of market environment, and I talked about this early February, somewhere around here, where I said, hey, I have a fear of chop. And that was just kind of based off of instinct and experience. But we eventually saw this chop, right? And you wouldn't want to apply a trend trader's system in a market that is not trending. So you would more so just kind of gravitate towards, hey, we're either ranging, right? And we said range highs and then range lows. Or you could even say, in this case, we went from a range to more of like a consolidation, right? Where we saw lower highs, but then higher lows. And that just kind of portrays that exact same idea. So remember, the way that I see it is I have a 4 second rule. And within 4 seconds, you should be able to tell me, are we uptrending? Are we downtrending? Are we going sideways in the form of a range? Right? Or are we going sideways in the form of consolidation? So that would be, we started ranging and then we eventually consolidated, right? In these sort of market environments, you're not applying a trend trader system, which is the moving averages aspect of my system, right? I wouldn't be applying that there. I would be very much ignoring it and waiting until it starts to become useful once again. And the way that you kind of go about doing that and adapting is you acknowledge that this is an alpha, right? It's alpha, it's an edge, it's very clearly respected, it's clearly defined. We're portraying this arbitrary thought that, hey, we are quite clearly headed to the bottom right corner. A 10-year-old could tell us this. So, what are we going to use to portray that idea so that we can kind of get an edge and a jump before our 10-year-old and determine when things are no longer heading to the bottom right corner, right? And you would say, well, 4 hour 200s because we respected those several times as macro tops, right? So then this price action, you would reclaim, you would immediately assume bullishness, and you would only get 10% before immediately retesting your trend. That is technically the ideal sort of pullback long. That is, long your longs all in spot kind of entry zone. You only get about 5 to 8% push up after that. And then you immediately lose your trend all over again. So, what does that kind of tell you? Now you went from a 3 month long trend to like a week long trend to, okay, now you have to assume either downtrend or chop. And now you have to assume chop, right? Because we went from week long trend, week long trend after a 3 month long, right? Negative 50% kind of drawdown. You get 1 month, or I'm sorry, 1 week, 10%, 1 week, negative 10%, whatever, right? 1 week, or not even couple days, 10%, couple days, negative 5%, right? So now you're chopping. That kind of tells you, hey, you need to adjust. Stop applying a very static approach to the market. So again, I say this a lot, but your system is not going to be alpha 100% of the time. And again, we are using something very arbitrary like moving averages. Obviously, if we are downtrending and heading to the bottom right corner, these moving averages are going to be a kind of self fulfilling prophecy because they follow whatever price is doing, right? So if we were ever going to downtrend into literal zero for Bitcoin, you would have to see these moving averages sloped downwards, right? It's this self fulfilling kind of prophecy. But when we're not trending and we're going in a sideways environment, you don't want to be applying your moving average strategy. You will get very much chopped up, right? Assuming, hey, if we had to go to 100K, we have to do this first. Hey, if we were going to go to zero, we have to do this first. Hey, if we're going to go 100K, we have to do this first. Zero first, right? And you would just absolutely hate your life, and your entire portfolio would draw down very quickly. So um, the important part is not knowing when to apply the strategy; it's knowing when not to apply the strategy in the system, right? So I'm using a confluence of these things like gray boxes, moving averages, right? To give myself a general kind of understanding that, hey, there's probably some horizontal resistance in this region, as well as I know that there's like this macro trend resistance in this region. So I can kind of assume that if we were ever going to continue downtrending, this is a really good place to continue doing that at, right? So it's a nice place to put in a macro top. And to coincide with that analysis, I could also say, hey, if we reclaim those zones, well, now we are trending above that gray box. We've reclaimed the 4 hour 200s, our market structure, however we want to look at it, right? Doesn't really matter what time frame you'll look at. You would have to say we are in fact uptrending heading to this top right corner. Look at that. All of a sudden, our entire system agrees, right? And from there, we're either right or we're forced to readjust. In this case, all the way back here, right? This is July of 2021. In this case, if you make that assumption, you are right. You don't have to adjust. All you have to do is continue compounding across a lower time frame trend and maybe move up your stop loss a bit and kind of trail it. Maybe manage your position. In this case, you are trading a very high time frame, I would think spot position, right? This is a 50% move over the course of like a month and a half. So you're not going to be so eager to get out of that position. You just got out of a 3 month long negative 50% downtrend, right? So you're going to hold on to that position. You would scale assumptions and you would scale them very drastically. You would look to ride that wave. So the next kind of question that my good friend had was, Merck, how do you look to kind of scale your stop loss and adjust your position, uh, with entries? So the way that I do that, and I have another saying, which is often, or your entry is oftentimes your invalidation, right? So if we're entering a short here along these 4 hour 200s, that would also mean that reclaiming the 4 hour 200s would be our invalidation, right? So you would have your stop loss right above those highs. So your entry was also your invalidation. If you hit your invalidation, you're now no longer able to justify, hey, we are heading to this bottom right corner, at least on the daily time frame, right? You could still absolutely justify it on the weekly, but remember, we're using these lower time frames to remain actionable. We want to give ourselves a way of actually going and trading this price action so we can potentially make money. So we would scale assumptions and say, well, hey, yes, the weekly is still bearish, but we're now invalid in assuming that on the daily, so as of the past 2 months at this point, that we're still downtrending and heading to the bottom right corner. We can't justify that analysis anymore. Why not? Because we're above the gray box, because we're uptrending in terms of market structure, and because we've reclaimed a significant level, in this case, the 4 hour 200 moving averages. Remember, we like these 4 hour 200s, not because we like 4 hour 200s, but because Bitcoin likes 4 hour 200s. In this case, right? We're adjusting. We're asking ourselves what is relevant. So we would kind of scale those assumptions along with the 4 hour 200s, the market structure, the gray boxes, right? So the same thing that made you enter in the first place would be the same thing that would make you want to exit. That's the great thing about having a something in your system that is dynamic. Like market structure is continuously changing, right? We're either uptrending, downtrending, trading in a range, or trading in consolidation. So that's going to be dynamic. You have to adjust with whatever the market structure is doing. The moving averages are also going to be dynamic. They're not just sitting in one spot and waiting for price action to come up into them or down into them. They're going to continuously move with whatever price action is doing. So that's the great thing about having something dynamic like these moving averages. So if we go down to a lower time frame, right? In our previous video, we said scaling assumptions. So we kind of use the mixture of like a range, right? And that's kind of our range. I guess I could just do a parallel channel. Scaling assumptions, we have a bit of a range here. Let's delete the squiggly lines. And we have our 2 hour 200 moving averages within this range. Why are we using the 2 hour 200s on a lower time frame? Because although we love our 4 hour 200s, they're not actionable, right? So, or really, I should say, they're irrelevant. So things can be irrelevant for one of two reasons, or maybe, I guess, both. But they're relevant because we're not trading anywhere near them, right? If we're sitting here arguing, hey, 4 hour 200s, 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 yes, it's a valid analysis, but that's a 45% move, right? We don't want to sit there and wait for 45% to then say, oh, 44 hour 200s And that's the same argument we were making all the way down here. We want to give ourselves a more actionable analysis. So we're constantly adapting and shifting along with the market on low time frames. And that's kind of where that snowball into bigger snowball, into the body of a snowman, into a full fledged snowman kind of comes into play, right? If you ever wanted to build a big snowman, you have to start with the snowball first. So as the snowball kind of forms, we would be constantly adjusting. We go back to the 2 hour, and this is kind of where we can say we absolutely have a snowball. Why? Because we would stop applying a very trendy kind of style analysis because we would be able to determine that this is in fact a range. Let's look at something even lower time frame, like the 15-minute, right? So we are kind of ranging. Yes, the 15-minute 200s are still getting pretty nicely respected, but we are ranging within this price action. So that's kind of what we want to adjust into. And then after we reclaim something like our range lows, we're still trending along these 15-minute 200s. We even then go as far as to build that snowball higher than the 2 hour 200s and continuously scale it upwards, right? We would scale our assumptions along the way. All right, sorry. So we're scaling our assumptions along the way and we're building up that snowball. We're building these bullish arguments. So that's how we're able to even assume that we're going to see a test of our higher time frame trend of those 4 hour 200s, right? Because again, whether it's 30%, 45%, or even just 10%, we don't want to sit there and wait for that 10% to then start making the same bearish arguments that we are making 10% lower, right? That's not an actionable analysis. We're not giving ourselves any sort of edge in terms of what can we even anticipate? Can we look for price to move upwards? That would kind of make you fall into a very coping kind of mindset. And that's just refusing to be actionable. That is very much falling into complacency, continuing to make this argument of the 4 hour 200s, even at times when they're largely irrelevant, right? We would want to adapt. We would want to say, hey, that's a range. And then, hey, what are we respecting within that range? Hey, maybe the 2 hour 200s are being respected as a trend, even though we're still trading in that range, right? We want to adapt to those lower timeframes and build our argument sort of upwards. So that's how I'm constantly adjusting and adapting with whatever the market is doing. And that's how I was able to play the most recent move on the way up into the 4 hour 200s, even though on a high time frame, I was still macro bearish, right? I'm still macro bearish, but I'm longing. So I'm out trading bulls even, and I'm a bear on high time frames still. And the way that we're doing that is we're building up the argument. We're constantly adapting and we're scaling something like our stop loss, our invalidation, along with that snowball, right? So the snowball starts here with our 15-minute 200s and reclaiming those range lows. Reclaiming the range lows implies something like a deviation at the bottom of the range. And obviously, we would have to uptrend in order to reclaim anything, right? As support, you'd have to be uptrending first. What are we uptrending along? Those 15-minute 200s. Great. So now we have 15-minute 200s and range deviation to the bottom, which implies a push up into the mid range as well as range highs, right? So now we have an uptrend and we have something telling us expect mid range, expect range highs. We then go on to reclaim those 2 hour 200s, right? And now we have three arguments, or really even four, because you can say, hey, we have the 15-minute 200s, we have the range deviation on the bottom side, which implies range highs and mid range, which at this point is halfway fulfilled. We have the 2 hour 200s, which acted as a nice little sort of resistance on the way when we're kind of downtrending within that range. And any sort of market structure that you look at within this time frame is going to be bullish, right? It's going to be higher highs, higher lows. It's this coinciding idea. Now, you tell me, right? And if you show this price action to a 10-year-old, what are they going to tell you? We're heading to the top right corner, right? So we're probably going to continue heading to the top right corner. That's how we were able to justify that very simple thought and idea is we used something like 15-minute 200s. We used a range style analysis. we use the 2 hour 200s, and we can use something like market structure. And all of a sudden, all that we did was further justify our very simple 10-year-old understanding of we are now heading to the top right corner, right? So from here, we would kind of assume things and scale those assumptions upwards. Okay, we're heading to the top right corner, and we're doing that along something like 15-minute 200s. We have, let's say, our hourly market structure is bullish, right? Hourly is creating higher highs, higher lows, right? And let's say we're above our 2 hour 200s. And what else did we say? Range deviation, right? So we would imply range highs. So we can say, okay, let's look for mid range. Let's look for range highs. Let's even look for those 4 hour 200s, as long as, right? And that's the part that kind of follows up that analysis. As long as we're still above our 15-minute 200s, we're still implying a range deviation from the bottom side and heading to the top side, right? And we're still above our 2 hour 200s, and we're still uptrending on the hourly. Okay, cool, right? So now we've given ourselves an expectation. We are able to justify our expectation via 15-minute 200s, market structure, yada, yada, right? You get the point. We're also able to invalidate that expectation of upside. How do we know when we're no longer able to assume upside? When we lose our 15-minute 200s, right? When we break out above the range only to fall back inside it, now implying a deviation to the top side. When our hourly market structure breaks, right, bearishly, and then it enters this consolidation pattern where we're seeing lower highs and higher lows, right? And then that consolidation breaks downwards, right? So now we've pretty much lost every single bullish argument that we possibly had, right? That we created down here to assume, hey, that's our snowball of strength. Let's roll this snowball down the hill and see how big it gets. We've now lost that argument. So, in hindsight, we're then able to say, that was the test of the daily trend as we assumed, or not really as we anticipated, right? Or kind of wanted to play into via the long side and range highs and so on and so forth. And now, in hindsight, we would be able to say that here. In hindsight, that was probably a macro top. We're now downtrending along those 15-minute 200s. Our hourly market structure is bearish. We've re-entered the range, confirming a deviation on this side now, which means mid-range, and then what? Range lows, right? And let's see, the only bullish argument left at this point would be the 2 hour 200s, which we're currently testing. We're kind of bouncing off of, but you would at least be able to scale those assumptions into saying, well, the 2 hour 200s are the last kind of bullish argument left standing here. So when we lose all of our lower time frame bullish arguments, we can at least assume a pullback into our 2 hour 200s, right? Kind of like a -4, -3% pullback. Really not anything too crazy. But that's kind of how we would scale assumptions. So we would be able to roll that snowball down the hill and build it up. And then we would be able to melt that snowball back into like a clump of snow or a snowflake again. And that's how we're just constantly ebbing and flowing with whatever the market is doing. So when price action gives us a reason to want to adjust on any significant time frame, even if it's a very, very low time frame, something like the 15-minute, we can acknowledge that argument and we can build our way into a bullish mindset in this case, a bullish mindset because we know that we're macro bearish because again, we go back out to this daily, a 10-year-old can tell us, hey, this is a downtrend, right? So we need to build a bullish argument. We need to build a bullish mindset. And that's how we kind of refuse to be complacent or coping in the event that we eventually do go on to reclaim something as significant as those 4 hour 200s. We're building our way into that mindset. We're not just waking up one day and all of a sudden we're bearish, right, at 19K. And then here we are at 23K, 25% higher. And then we're going to say, oh, now we're bullish, guys, right? So this is kind of how I use my system. I hope this kind of sums it up for everyone, as well as my friend who's watching this right now. If you managed to watch the whole, I don't know, 20 minutes of me rambling, Thank you guys as always. Very much appreciate all of your support. If you want to use my Bybit referral link, that would be very much appreciated. Come ape with me. I love Bybit, by the way. Um, and yeah, I have some donation links in the description below if you want to donate to me and get me out of my grandmother's basement, and also to be able to afford some avocado toast during the bear market. But thank you so much, guys. I hope you enjoyed the video. I hope this clarified some ideas about how I use my system and whatnot. And yeah, much love. Take it easy.